Hello and welcome to another ACY Securities market update. My name is Alistair Schultz and I'm going to try and guide you through today's trading journey. Now, what we've seen so far in markets overnight is most global indexes are back up in the green, at least from their falls that they've had last week. Now, looking at what we might be anticipating for the week ahead and what's actually caused it, well, it all comes back down to bonds and inflation. We've had a lot of concern over the last week about bonds rallying in yields and potentially seeing issues with that rising on the inflationary side as well. It's given a lot of investors to have a little bit of a meltdown. They've gotten the jitters from what's actually happening and they're now concerned about where inflation might travel next and how quickly it builds up. But fortunately for us, we've all heard from central banks in the last couple of hours, or at least in the last day or two, the RBA, the Bank of England, and now the ECB is even talking about it whilst the others have already provided action. What's going on realistically, we're seeing that we've had an increase in bond purchase programs, particularly here in the RBA, where they've nearly doubled it for the monthly basis. Now, why does this mean that we're going to get a better result when it comes to equity markets moving forward? Effectively, this means that we draw a line underneath where equities are now, and we end up with a bit of a floor that's going to support them. And the central banks have basically turned around and reassured us all that, look, we are going to be keeping rates extended for a long time at low levels, and we are trying to foster for that maximum employment, and inflation is still okay. So they've given a little bit of confidence back to investors. So we've moved all of that away from where we had before. People became more attracted to bond markets, and we're probably still going to see people attracted to bond markets. Now, when it comes to inflation, people generally think about the idea of what happened in the 1970s. But we don't have the Bretton Woods Agreement that is driving up and turbocharging rate increases. And of course, we haven't got the same oil shock that we had back then. These days, we have to look at the scenario perhaps being a little bit similar to what Japan has had going on for the last couple of years. They have low rates and are trying to get inflation to get higher, which has not been a very easy task for them, and they are still struggling to do so now. Of course, what does it mean for us as traders? If we do start seeing inflation go up, it's not a bad thing, provided it remains at a gradual level. It means that those yields are going to go up as well, and we do have more alternative asset classes to trade in the fixed income markets. But not only that, it means that if it's a gradual increase, equities will be able to absorb the impact. If we do start getting spiking behavior occurring like we've just seen, then it becomes a little bit of a problem because you can't anticipate how high the jump is going to be and how sustainable that jump is going to be. If we do see the jump and it sits up a little bit higher, then naturally it's going to increase borrowing costs for most firms that have taken on some of the stimulus relief packages. Of course, we currently have clear evidence from central banks that they are going to try and support the economy to the best of their ability. But with such low baselines, I think some of these spikes are probably going to be inevitable over the next year before stabilizing a little bit easily on. Now, the other side to really consider in all of this is technology. If we look at technology and advances in technology, it generally acts as a deflationary pressure. So whilst we're seeing tech firms rise and rally up, then potentially with the increase and better advancements in tech as we move forward, which has probably been kicked into overdrive considering the pandemic and the need for tech firms, they're likely also going to perform as well. Of course, I'm now not thinking that tech is going to be the top performer for the entire year. Instead, I think we're going to be looking at a case of those reflationary trades really driving the market in this time round. Now, what does this really mean for equities at all? It means that we are probably still in a bull market for some time to come. And now that we have a bit of a floor beneath us, the theme is likely going to be vaccines versus rates for most of 2021.